Hi everyone, thank you for attending today's webinar. It's great to see so many familiar and new faces. My name is Ashley and I'm the Head of Communication and Account Management at Trove Research. So for today's talk, the panelists are going to be Guy Turner, our CEO and founder, Ian Porter, Lead Analyst for Supply, Gregoire Mazes, Lead Analyst for Pricing, and Lucian Georgeson, Lead Analyst for Policy. The first half of our voluntary carbon market Q1 review will be a presentation from the Trove team. We will begin with Guy, who will summarize the latest on corporate climate commitments. Ian will then take you through what's happened with issuances and retirements, and hence how the market surplus has changed. Gregoire will then discuss historical price movements before Guy covers our 2022 pricing outlook. Finally, Lucian will highlight what to look out for in upcoming months and touch on key policy developments that have taken place so far this year. The rest of the webinar will be spent on Q&A. For the Q&A, attendees are automatically muted. If you have any questions, please type them in the Q&A section throughout the session, as I will be monitoring this throughout the webinar. I will then channel the questions back to the Trove team, who will answer them in the second half of the webinar. If you have any clarification questions, please also leave these in the Q&A and we will answer them as soon as we can. These slides, along with the recording of the webinar, will be uploaded to the Trove Research website tomorrow. Feel free to also circulate these slides around your organization. Before I hand over to Ian, I will pass the floor to Guy, our founder and CEO, for a brief introduction of Trove.
Thanks, Ashley, and welcome everybody. Such a Zoom that I can't see everybody, although I see that we have 278 people on the line. So welcome, and please do put your questions through to Ashley. We won't take questions during the session. We'll bundle them all up to the end, just so that you have all the material and all the answers en route. For those who don't know Trove, the fact that you're here means that you know of us and have come to visit this webinar. For those who don't know the details of what we do behind the scenes, we were created a year and a half ago to really provide a lot of much needed transparency and data around the growing group of companies that are making voluntary climate declarations and commitments, and their use of carbon credits. And we structure our work around 4 key themes. We monitor the policy landscape in a lot of detail, because that is going to influence how companies approach these commitments and their use of carbon credits, and we have a very structured way of doing that. We monitor carbon projects and transactions around the world, 4,500 projects, and Ian will show you some of the analysis that we do there. We look in a lot of detail at what companies are actually claiming and the emissions that they are that they cover, scope 1, 2, and 3, and what kind of carbon credits they're going to need and when. And then we look at carbon credit prices in a lot of detail with a weekly summary, tracking them inside and out. And increasingly, we're looking at projecting where this market is going to go, how many companies are going to be needing carbon credits, what kind of prices they're going to be transacting at over the 10, 20, 30-year horizon. And that builds on our fundamental modeling of the costs of doing projects and the willingness to pay of certain customer groups. And you'll see more of that coming out from Trove Research in the next few weeks and months. So that's a little bit about us. And if you've got any questions about how to get access to what we do, please follow up independently. So I'll just quickly kick off with a review of what's going on the commitment side. And as everyone on the call probably know, a significant source of claims is the Science Based Targets Initiative, and we track those. We look at the number of companies that are signing up. We also do a lot of tracking of companies outside the SBTi and look at their emissions profiles and emissions commitments. But in Q1, the momentum that we saw building over 2021 and 2020 has continued, and that's really pleasing to see. I think some of us in the industry thought that we might have seen a bit of a peak during Q4 last year, with COP26 and all of the goodwill and positivity that we saw around that. But that has continued into Q1. We had 486 more companies sign up to the SBTI in Q1, with an increasing emissions coverage of 370 million tons of scope 1, 2, and 3 commitments. Some of the companies that have joined the group include Honeywell, Schroders, BMW Group, Lufthansa, Asda. So often, a lot of the SBTI companies tend to be smaller, but there are some really significant companies included in that, and that will lead to longer term use or need for carbon credits, particularly removals. The implication of those companies for nearer term demand is more equivocal. We do model it, but in a different way. But it sets the foundation for the medium and longer term industry, really, in regards to the companies that are looking to invest in carbon reduction projects and giving some long-term certainty over that. So that really sets the context for what we're seeing in terms of the developments on the supply side and pricing that we've seen in Q1. I will hand over now to my colleague Ian, who will walk you through a few slides on what we've seen on the supply side in Q1.
Great, thanks, Guy. As Guy said, I'll be talking about the market movements that we've seen recently before giving a bit of our insight into what we expect in the short term. So the market has grown pretty significantly over the last 5 to 6 years, but this isn't a uniform picture between different project types. So if we look at the main 4 registries, we look at Verra, Gold Standard, ACR and CAR, then we see a mixed picture. Renewable energy and REDD+ projects have seen pretty significant growth, particularly in the last 3 years, whereas other project types such as nature restoration or energy efficiency have seen a smaller increase. What's interesting is that in Q1 2022, we saw roughly the same level of issuances as we saw in 1Q21, which is a slight decrease from the previous 3 quarters. If we look in particular at REDD+ issuances over the last quarter, we have REDD+ issuances have historically been pretty volatile between quarters. So in the last quarter, 50% of issuances for REDD+ credits came from just one project, for example. So big projects still have quite a significant effect on the overall picture. If we then look at retirements, we can see a similar pattern, but with more consistent growth. So Q4 2021 saw the COP effect, amongst other reasons, culminate in the highest level of retirements on record in a single quarter. Q1 2022 was the second highest on record, and similar to issuances, predominantly led by renewable energy and REDD+. So we also, other features we've seen from Q1 2021 is the highest level of retirements of non-CO2 gases in a single quarter. So whilst this is seems quite significant, actually, again, this speaks to how individual movements can affect this entire market. Because 50% of those retirements for non-CO2 gases in 1Q22 were actually just from one project, the Hyundai Steel Waste Energy project in South Korea, and retired on behalf of one beneficiary. Other things to note is obviously the crypto effect. I think that brings us on to our next slide. So retirements have grown significantly over the last few years. And last year we had 162 megatons, up from 95 megatons the year before. So retirements, for those of you who are newer to the market, are the end of a credit's life. So a credit will be issued, created, and then when a person, an individual, or a company wants to offset their emissions, they will take a credit in their ownership to the registries and retire it to offset their emissions. We can also have retirements, as we saw in late 2021, from cryptos. So I'm sure many of you will have heard of KlimaDAO or Toucan. In 2021, these actually amounted to about 10% of all demand. And specifically, we're very much focused on Q3, Q4. Now, it's going to be interesting to see how these pan out, and if this is more part of a more long-term trend, or if this is a bubble. We also track cancellations. So whereas retirements are the end of a credit's life, cancellations are transfers of credits to the California compliance scheme. So the California compliance scheme recently changed at the start of 2021 its allocation for company emissions to be offset using offsets. So in 2021, that reduced from a 10% allowance to a 5% allowance. So we've seen a decrease in the amount of cancellations going towards in the number of cancellations. Interestingly, these are all, as set out by the market, these are all only of three types. You are only allowed to transfer in CCUS, non-CO2 gas credits, or nature restoration credits, predominantly the latter. Now, the surplus is the culmination of the last three slides. So the surplus can be thought of as the number of credits that have been issued that are currently available for retirement. So the way we calculate this is simply issuances less retirements and cancellations. So at face value, you can see the surplus has increased dramatically over the last 3 years. It's nearly double the level at the end of 2019 and about 2.5 times the level at the end of 2018. Again, this is predominantly a factor of renewable energy and REDD+ credits, both of which being reduction credits as opposed to removal credits. You may also have heard of reduction credits being referred to as avoidance credits. And these renewable energy credits are a mixture of projects that are developed ground up in the 4 registries, but also projects that have their roots in the CDM and have been traced through, converted onto the main 4 registries and into the voluntary market. If we take the specific case of nature restoration, which are predominantly removal credits, then actually the surplus of removal credits really hasn't seen much of an increase over the last few years. If we then draw a comparison between the surplus and the retirements, so retirements being the demand, actually it tells a bit of a more interesting story. So whilst the surplus might be increasing, the surplus as a proportion of retirements, the ratio, has been steadily decreasing since 2017. So in 2017, the volume of the surplus could have covered 5 years of retirements at 2017 levels, whereas now the surplus can cover about 3.5 years of retirements at 2021 levels.
Yep, thank you, Guy. And nice having you all here. Since we have started capturing and analyzing prices across the voluntary carbon market, there have been 3 or 4 major trends that we've been able to observe. The first of which you can see on this chart. So that first trend is that prices are increasing in a somewhat volatile but rather steady manner. The average price across all technologies has risen roughly 34% over the past 6 months. And that's using as an endpoint week ending April 17 prices, as they were still recovering from the European war, and roughly 175% between June 2021 and late February 2022, when they were at their highest point. This chart that you're seeing now uses data which we received from a multitude of seller partners and from exchanges. So it takes into account potential markups between the two. And what we're seeing here is that the market fluctuates alongside both global equity markets and investor sentiment in carbon offsets. For example, prices have been increasing steadily over Q2 and Q3 2021, and then they just jumped 59% during and through COP26, because negotiation brought a little more clarity and a little more attention to VCM, to Article 6, and to NDCs. So policy, as well as the value that companies may put on voluntary commitment to get ahead of regulation or for pure PR, as well as the future value that investors may ascribe to it, are obviously major drivers of prices. And that makes sense because the future role of the VCM is contingent on these different things. But also we see that any major movement in global finance will potentially erode confidence in this value for a time, as shown by the impact of the war in Ukraine, where prices dropped 37% over the course of a single month. And there is obviously a premium for quality and different trends by criteria, such as issuing registries or for vintages. For instance, we'll generally see higher prices for more recent vintages. And most importantly, there is a difference by underlying technology. And so on to the next trend, we want to show you the average price per credit per week for project types. And to do so, we should probably talk first about our own project type classification. The way we, as in at Trove, think of carbon credits currently is to classify them as nature restoration, which is essentially, like Ian said, what market players understand as removal credits. RED+ project, energy efficiency, fuel switch, and non-CO2 gases. And to answer very briefly a question that popped up in the chat, that includes a lot of assets-heavy and industrial processes that are typically larger emitters of methanes or HFCs than CO2. And all these categories have subtypes. So looking at the next chart, what we've predicted and then observed is that the prices of nature-based solutions have risen above the other technologies. Nature restoration and RED+ credits have sort of battled over time, and we expect that nature restoration will come on top eventually, because a consensus around the need for removal credits to reach net zero has emerged under the guidance of the Science Based Targets Initiative. And by extension, the last major trend is that nature-based solutions have converged toward towards similar prices, while other technologies have converged around a lower common range. Nature-based solutions hovers around $13 to $15 per ton right now, while other technologies move around an average of $7 per ton. And when we update this chart constantly, right? And so in the past 2 weeks, we've only seen this trend solidifying. And unless something major like very large investments or policy shifts occur, it should continue to do so in the future. And I'll hand it back to you, Guy.
Thanks. Thanks, Grégoire. So this is really just the tip of the iceberg in terms of what we do on weekly pricing analysis. So if anyone has any more interest in detailed sort of pricing data, then please do get in contact. We've had a few questions come in. I'll just pause for a couple of questions. It was actually on Ian's section on the capacity in the market. Just going back to these slides here, really they're calculated. The capacity volume is calculated by the difference between the theoretical maximum issuance capacity every project could issue cumulative over time, and how many they actually issued. So therefore the capacity is the difference between the theoretical maximum and what they actually issued. And as Ian shows on slide 11 on the right hand chart, the bottom one adjusts that capacity for the known underperformance of several projects on the basis that they will not issue their full capacity. Another question around the quality of the backlog, and really are the long dated vintages or types of projects still worth putting into the market today, given the drive towards higher quality. And I think that's a great question. Whether the market will accept those and buy them at today's prices, given their long dated vintages, and so a lot of them are old renewable energy or similar types of projects, then I think you might see a price, certainly a price discount for some of those long dated types of credits. There's quite a few questions coming in. I can't deal with them all simultaneously. I'm going to ask Ashley and Jamie to bundle them up, and we'll come back to those. But those were a couple of salient questions that came through. So we've given you some information on the market situation, the pricing history that we've seen in the market. Now we want to hand it over to you for a bit of audience participation, if we may, and get your feedback in terms of what you think the price of carbon credits will be year end, so end of December this year, for different types of credits. And we've categorized these into 3 types. So there's renewable energy, energy efficiency, and you could add non-CO2 gases as well to that. So these are all reduction credits, and we've given bands of dollars per ton of CO2, 3 to 6, 7 to 10, 11 to 14, 15 to 18, 19 to 22, and 23 to 26. The second category is Red Plus. Those are also reduction credits, but a very particular category, and are trading today at a different price to the other types of reduction credits because of their their nature and biodiversity benefits. And then thirdly, nature restoration, so removal credits, which Gregoire showed were trading at a high price today, somewhat in line with red, but for different reasons. So you've got that price, that multiple choice question in front of you, and we'd like to get your views by ticking one of the boxes for each of those 3 questions, and we'll try and play back the answers in as real time as we can. Ashley's nodding, so are the results coming through? We've had one fewer in 1 minute.
Yeah, we'll just give everyone another minute.
We'll give you another minute, and we'll give you our view after we've done this. We'll give you our view of where we think 2022 is going to end up, and we'll see whether there's whether we have got alignment with the wisdom of the crowd, or whether we're off, or whether the crowd is off. Who knows?
Okay, guys, I'm going to end the poll now.
You're going to end it? Okay, has everyone
last chances
handed their votes in?
Great.
Ashley, can I hand over? Are you going to reveal all?
Yep, I'm going to share the results now, everyone.
Okay, let me digest this. We have renewable energy efficiency credits. So the modal one, the most frequently used cited one, is $7 to $10 a ton at the end of the year. That is higher, a bit higher than we're trading at the moment. If I go back to Gregoire's slide, they're trading at 5 to 7. So the wisdom of the crowd taking that modal response is a bit of an a bit higher than where we're at the moment. Under red, we've got 15, the modal. It's quite an interesting distribution, nearly a normal distribution, around $15 to $18 a ton. Some saying they're going to be less than 6. A few bullish people out there thinking they're going to be 23 to 26. But a really nice distribution around 15 to 18. And we're currently at about 14. So again, a similar percentage increase the market expects throughout the year to end the year slightly higher. And then on nature restoration, a really interesting distribution there, considerably higher. The weighted average of that would be nearer 20, I would say 19 to 22. So really quite a bullish sentiment around nature restoration compared to the other two types. And the difference between, that's a very interesting expectation, the difference between renewable energy, energy efficiency at 7 to 10, with nature restoration nearly double by the end of the year. Now, time will tell how those prices play out. We've taken a view on where we think those. Well, can we send these results, Ashley? Can we send these results out as part of the info pack afterwards? Yeah. Okay. Great. So really, thank you for that. That's really interesting. So we track prices, and we've taken a view on where we think prices are going to come out at the end of the year. We've got price outcomes for different types of projects, slightly less bullish than the market view at the moment, actually. And I think that part of the reason why we're potentially less bullish by the end of the year is this weight of overhang of the surplus, which can come to market quite quickly. We see significant price increase over the medium to long term, particularly for projects which are short in supply, like the nature restoration credits, where the demand is exceeding supply and is likely to over the all time periods, actually. But some of the key factors which are going to drive those prices are the nature restoration, the demand for removals, particularly backed by biodiversity and ecosystem benefits that we have in restoration projects. Reduction credits, particularly the high volume ones, the renewable energy, energy efficiency, of which there are a lot. And interestingly, we see in the pipeline through the gold standard registry a significant volume of renewable energy projects still coming through, particularly from countries like Turkey or India. And the size of those projects are still significant. So that supply could continue. What happens to prices will be to some degree influenced by what buyers want. Yes, they will tick the box of verified credits that can be used, but the quality criteria will evolve and buyer preferences will evolve. So that will be it's a variable which is difficult to model, but may have an influence on that spread of prices, particularly with the bulk renewable energy and energy efficiency and non-CO2 gases large volumes of them coming to market. But because of that volume of surplus that Ian mentioned that can be issued, what is issued, the 580 million tons, and also the volume that is built up that has yet to be issued, that can weigh on the market at certain points in time. And the balance between how much comes to market and where demand needs to go could lead to volatility, particularly over the remaining part of the year. And then that separation of high quality credits, particularly the nature restoration ones and the high quality red projects, which we expect to demand a premium. So we're not quite high. We're not as bullish as the Vox Pop has shown for either restoration or Red Plus. We're sort of more in line with Red Plus, actually. The median was about $15 to $18 on the Vox Pop. We're about $12, and we're a bit I think we're more in line with the reduction, the volume reduction plays on renewable energy and energy efficiency. But what we've done is plug these numbers into our volumetric forecasts as well, and come up with market sizes. So $1 billion market sizes, and this is the left-hand chart is where we saw the market turning out at the end of 22 as of January this year, based on what we knew in Q4, volume times price. So primary demand is retirements times weighted average prices, and we've upped those now. So we've shaved a little bit off demand, particularly with the crypto bubble. Ukraine has had an effect. How long it will last remains to be seen, but that's been more than offset by the increase in prices that we've seen in Q1, rolling over from Q4 last year, and as we've been talking about, a continued upswing in prices, not as much as the poll has suggested, but still an uptick in prices. So we've increased our market size estimates by about a quarter, like 26%, to $1.9 to $2.2 billion of primary demand. When you look at the churn in the market, the number of times carbon credits are traded, we're looking at a potential ×3, ×4 churn rate in the market these days, and that could lead to $6 to $8 billion market size total volume transaction. So in the scheme of how much money needs to be spent to solve climate change, it's a drop in the proverbial ocean, but it does show a trajectory that has accelerated very rapidly in the last year, and we expect that to continue through 2022. And the way that we model the market over the next 10, 20, 30 years continues that momentum and that growth, in the short term driven by the momentum towards carbon neutral claims, but then transitioning towards net zero claims that a lot of the SBTI and related companies have made commitments to, and assuming those companies maintain those commitments and follow through on them, we see a very significant growth in the long term, but which will drive even higher prices, largely driven by fundamentals at that point. The cost of doing a good project will rise as the cheaper ones run out, and we'll pick off the low-hanging fruit. And that was the subject of the report that we issued last year with UCL, the fundamental modeling report, and we're currently updating that, and we'll release a version of that in the summer of this year as well. So that's our view on the future of the market. I'm just going to hand over now to my colleague Lucian, who will give us some pointers as to what to look out for and what headwinds or sidewinds or tailwinds may affect the market over the rest of this year from a policy point of view.
Thanks, Guy, and thank you to all for joining us. It's great to see so many of you on the webinar today. Really happy to have you here. So I just wanted to start by just quickly introducing our approach to tracking policy and guidance updates here at Trove. We are currently tracking over 140 organisations across the 8 different guidance areas that we define, that you can see on this. You can see here, which is split across 4 different main audiences, which are for investors, companies, the supply side, and public policy. Month to month, we make an assessment of the consensus between organisations on key issues within these different areas, based on the new updates from those organisations within that month, the new updates, new guidance, new reports, new research, that kind of thing. So as we can see, across a number of areas, in the last 1 to 2 months, we've seen an upward trend in the consensus that we have assessed. Particularly, some of this has been due to a volume of updates being put out, particularly in investor pressure for climate action. We've seen consistent messaging from investor pressure groups like the Climate Action 100 and initiatives aligned with the UNEP's finance initiative. What investors are expecting from companies is trending in a certain direction. We're seeing particular consensus around that, or where we're seeing particular alignment between key updates. For example, in March on accounting and reporting, we saw new drafts from the International Sustainability Standards Boards and the US's Securities and Exchange Commissions on reporting and disclosure. Seeing the alignment between 2 very big initiatives like that suggests to us that there's direction of travel in terms of consensus there. Over the next quarter to 6 months, we may see more activity where there is significant higher consensus, like under investor pressure for climate action, or where there are important areas where debates are still ongoing, particularly around defining carbon credit quality and also how companies use carbon credits towards different targets and claims that they make. For a couple of minutes before we have some time to get to all of the excellent questions that you guys have been sending in, I just wanted to highlight a couple of the important policy updates that we will especially be looking out for in the next few months. So to start with, from the Integrity Council for the Voluntary Carbon Market, which was launched by the Task Force for the VCM, the public consultation for the core carbon principles will begin in May, and they'll be looking to formally launch the core carbon principles in the autumn, probably in September. The CCPs is a key effort really for this governance organisation to define what a high quality credit looks like through an assessment framework for both at the standard and the methodology level. This will be really important for buyers and intermediaries to be able to identify what a high quality credit in the market is like through something that's been reached through consensus. The CCPs will also create a system where it will be possible to tag other attributes of credits, like is it a removal credit? Does it carry a corresponding adjustment? Does it have other societal or environmental benefits? Which will facilitate corporate claims and through the purchase of credits which align with what the company is trying to do. In a similar vein, but more on the company and buyer side of the market rather than the credit and supply side, the Voluntary Carbon Markets Integrity Initiative will be launching draft guidelines for businesses in June. This will mostly focus around the kind of language companies and corporates can use in terms of the claims they're making and how that should align with certain behaviors they're taking, as well as how they can demonstrate progress towards what are very long-term targets, in many cases with 2050 net zero targets, without being accused of greenwashing or not delivering significant progress in the short term. And finally, it will also look at key issues around the levels of claims, what terms companies should be using to refer to different targets, different achievements, whether the coverage of that achievement or claim is scope 1 and 2 emissions or scope 3 included. We think, as they've announced, it will be a very busy year for the SBTI, for the Science Based Targets initiatives, but one thing we're particularly looking out for and following will be the development of the net zero standard for financial institutions. Earlier this month, the SBTI released the conceptual paper to give the foundations of that, so we have a pretty good idea of what the kind of questions that they'll be delving into through their expert groups will be over the next few months. This will particularly involve defining net zero for financed emissions, what that covers in terms of different types of lending activities, different financing activities, how financial institutions will be able to use offsets, which we think will track closely to the corporate net zero standard the SBTI released last year, whether there will be a specific commitment required for fossil fuel phase out within the net zero standard for financial institutions, and what recommended actions and in what order financial institutions should follow in order to reach these targets. Should they prioritize investing in new solutions, engagement with companies to help them reach their net zero targets ahead of divestment, or changing the focus of their portfolio? In the run-up to COP27, we think the key issue that will be a focus following on from Glasgow last year will be clarification around the implementation of Article 6, and particularly what is the role of the authorization for host governments, even for voluntary claims. Do credits going into the voluntary market require an authorization from the host government? And if they don't, can governments choose to turn a blind eye to credits going into the voluntary market and therefore not have to adjust their own nationally determined contributions by authorizing those credits within the process that Article 6 sets up? And finally, on the supply side of things, we'll be looking out for the updated forest-based methodologies from Vera. The consultation for those are currently ongoing, with particular questions around baseline updates, crediting periods, and greater alignment between project-based REDD+ methodologies and the the growing interest in jurisdictional baseline and jurisdictional approaches, and also growing focus, as we've seen with new approved methodologies for technology-based removals from gold standard, whether this will continue to develop in 2022. The final thing we'll be focusing on is understanding what's going to be the impact on the carbon market, the VCM more broadly, of the growing interest in jurisdictional-based REDD+ and nested REDD+ through the art trees standards, the Leaf Coalition's support for art trees, and Vera's jurisdictional and nested REDD+ standard. Well, there's huge amounts of interest in art trees, no credits have been issued yet. So how this develops over 2022 and how this influences the broader carbon market will be something else we'll be focusing on. I'll hand you back over to Guy and Ashley now.
Thanks, Lucian. And it's super important to keep a track of those issues, because they will affect the market, maybe not over the next 6 months or 12 months, but they can affect the shape of demand and the shape of supply over the next 5 to 10 years, which I think is where a lot of the investor interest is focusing right now. So we've had, thanks so much for the team, we've had quite a few questions coming through on the Q&A, so many so that it's difficult to distill, but what I'm going to do is pick 2 or 3 of them that I think are particularly interesting to air. One was about companies such as Microsoft pushing for removal credits rather than avoidance credits, and that seems to be getting traction, yet your graph shows an increase in avoidance credits. What's going on? Well, because the charts we showed were all historic issuances and retirements, there just haven't been many removal credits issued to date. And the projects that are doing that are really nature restoration. There are some technology projects, direct air capture, enhanced weathering, biochar, but those are small and really at the early stages. So one of the things that we do for subscribers is we model demand by project type over the next 5, 10, 20, 30 years, and we can show how the difference between the demand for different types of projects will match the supply or not, as the case may be, and where the investment needs are going to take place. So that's one area that's highlighted through that question, where there's going to be a significant investment need if companies follow through on their commitments. Another question about the data available on entities that are purchasing or cancelling or retiring credits, breaking down by type or region. A great question, one we get asked a lot, and we have built a pretty comprehensive database of company retirement activity, and we're building on that all the time. And that's again something that we take very seriously, because that really is part of the transparency of the market that we're trying to enhance through all of our work. What effect could vintage restrictions have on the surplus and also on prices? Right, so we've seen some proposals for producing tradable contracts that limit the vintage, like a rolling window of vintage eligibility, which would knock off older credits. We think that's a good idea. I think it accords to the issue of quality, and recency is something that a lot of buyers seem to take seriously. So that we can model that by just taking older vintages out of the market, and it would have an uplifting effect on prices, I think. But it has to be mirrored against what buyers actually want, and if they want to buy the more recent stuff, then their price differential will be created anyway. Something about crypto. While I'm just picking out these things, Ashley, if there are any particular questions that you've seen that have come through, please do bring them to our attention and the team.
Yep, sure. So we've compiled a list of questions. A few of them were pretty similar, so we've tried to group them together. Like Guy said, thank you guys all for your questions. The questions that we don't answer, we'll try our best to follow up with using your guys' emails. But for the time being, we had a few questions actually around price sourcing. I know some detail is confidential, but can we explain in a bit more detail how we aggregate our price averages and which standards are used, and do they include both over-the-counter and exchange trading? Do we include pricing through crypto platforms? So perhaps either Gregoire or Guy, if you'd like to answer those questions.
Gregoire, do you want to go?
Yeah. So yes, it's always a thorny question because we work on the basis of multiple partnerships, and I don't want to reveal too many personal information, but we do have partnerships with market participants across the market, be it developers, general OTC players, or exchanges. And we make sure to differentiate these different categories every week. So we receive prices marked up by project ID, by vintage, by volume, by price, so these sort of things, and aggregate prices into these different criteria that we've mentioned, such as vintage or registries or project types, and always by weighting by volume.
Great, thank you, Gregoire. And we have another question. Why do EU buyers strongly prefer to buy nature-based credits, although the price is much higher than credits from other sectors? Separately, Adam has asked that within nature restoration, is there much divergence in price between specific project types, i.e. mangroves versus another type?
Can I take the second one first? Well, maybe Gregoire takes the first one. The regionalization of the market is starting to become more apparent, and we are starting to see different buyers with different needs forming in Europe, North America, and the rest of the world. So the proximity of the project to where the buyer resides, say for example UK or Europe, does drive a different set of interests. So we've got in the UK different types of woodland projects that are being developed to meet local buyer needs who want to be seen to be supporting local projects, particularly on the forestry side. And they form into two categories: natural woodland, restorative woodland projects, and those related to a sort of single sort of conifer plantations, but also with a carbon layer tagged on the top, providing that they comply with the standards. And the same is forming in North America as well. And we do see a price differential between that and the tropical forest projects, that the big projects that are being undertaken in that part of the world. Regarding price differentials, it really does depend on the type of project. Generally, the North American and the European prices are slightly higher on per ton than the bulk projects you're seeing in the tropics, but that's not exclusive. There's a big range, and it is something we're monitoring and will be releasing more information on shortly.
Greg, did you have anything to add?
No, you can go to the next question. Thank you.
Sure. So Guy, maybe this is a question to you about forecasting. So when do you think the market surplus will disappear? In 2025 or before? Related question is, what's Trove's opinion on the catalyst to 50 plus tons plus prices for quality credits? And another one on forecasting, what could affect vintage restriction? What effect could vintage restrictions have on the surplus and also prices?
Right, I think I dealt with that last one in my sort of random skim through the project. But Ian, can I flip over to you, because you model the surplus going forwards with your very sophisticated supply side modeling. Do you want to just educate us all on something on your surplus modeling?
Yeah, I'd love to. So without giving away our crown jewels, I mean, we have modeled this pretty extensively. So it's a case of taking into account what exists currently, so the surplus in the market, what we think will come onto the market, so the pipeline, as well as what we expect to come into the pipeline, and then just cross-referencing that with our demand forecasts. So I mean, we have this quite detailed write-up of this for subscribers, but I don't want to divulge all to the wider world. But certainly I think it's clearly a function of what assumptions you make around the future of demand. I think it's more of a demand-based question than it is a supply-based question. If you model supply in a good level of detail, you can get a pretty good estimate of its outlook.
And I think from recollection on that work, in the sort of like the medium range of supply based on our forecasts of increasing demand, that supply starts to run out in the late 20s, early 30s. I think so 25 to 30 is sort of the range of when we really start to need new projects coming to market.
Yeah, that's all wrong range.
Yeah. So sort of in the visible future.
Great, thank you guys. And we've got another question. I appreciate also we're almost at the time, but we're happy as a Trove team to stay on for a few more minutes to answer the rest of, or some of the rest of the questions. But appreciate if you have to drop off now. Thank you so much for attending. So for another question, we've got quite a few questions around the buyers of credits. First, is there data available on the entities that are purchasing, cancelling and retiring credits? And separately, Raviani has said that it's interesting that with increasing fuel costs, offsets are the first to be dropped, as seen in our own recently published Q1 fossil fuel shipments report. Reflecting on that, is there any indication of seriousness of climate action versus profit protection?
Yeah, who's retiring credits and who's making use of them is yeah, I alluded to that earlier. We are building a comprehensive inventory of that information. So watch this space for more information on that. The price responsiveness of it's a great question, and something we spend a lot of time thinking about. How willing are corporates? How willing are they to pay for the higher price credits? And especially when there are other forms of fossil fuel are raising in prices too. And yes, you're right to refer to our Q1 fossil fuel shipment report, which did show a significant drop off in carbon credit use for LNG and oil cargoes in Q1. It's an unknown answer. There will be some price responsiveness to higher fossil fuel prices, and I think that's what we'll see as a long-lasting effect of the Ukraine situation. A reshuffling of the global oil and gas markets will lead to higher equilibrium prices over the medium to long term, and that may have an effect on the discretionary spending that companies want to spend in this sector to solve climate problems. So I think directionally you're right to raise that question, and we agree with it. I think the question is on scale of effect, and it is something that we build into our models, our price forecasting models anyway. The elasticity of response to higher prices.
Great, thank you, Guy. We've also had a few questions on crypto. First, someone has asked if you can clarify what is meant by crypto-related retirements. Second, Peter has asked what types of credits are being retired in relation to crypto. In particular, are they typically poor quality vintages?
I can answer that, but Ian, do you want to take that one?
Yes, if I can find the mute button. Yes, absolutely. So we dug into this the other day. I mean, you can see, I think about a quarter of all crypto retirements are like renewable energy, wind, and quite a lot of them come from India and China. Think judge the quality as you will. There's a range of them that wouldn't necessarily lend themselves to be the most recent. There are some more recent ones in there, but it's definitely a range. And
one of the whether you believe this or not, but one of the stated intentions of some of those crypto platforms is to take those older vintages out of the market to help clean it up. Now, there's different interpretations of their motives, but that's one explanation that's been put out into the public domain. You're right to address timing, Ashni. We're past the half past. I think we should probably draw it to a close.
Sure.
I would just like to thank my team for all the work that they do day to day and in preparation for this webinar, every one of them, and also everyone on the call for attending. Hopefully this has been useful. Please do follow up with further questions. We will be holding further webinars on this murky world, an interesting sector throughout the year, so please look out for those. And any further questions on what we can do to help and illuminate, please do get in contact.
Thank you, everyone. We'll be sending a follow-up email with the details of how to find the webinar recording and also where to direct your questions. And we will try to follow up with as many questions as we can. So thank you all for attending. We appreciate your time and hopefully see you at the next webinar.
Thanks, everyone.
Thank you so much, everyone. Have a great
Thanks,
day.
Cheers.